stocks with a little bit of volatility here this week, but as we were making new highs, VIX was static and stuck at 20 anyway. Let's bring in Cem Karsan and let's talk about volatility and what he sees happening in markets right now. Senior Managing Partner at Aegea Capital. Cem, always good to have you on the show. I want to start by talking a little bit about what's kind of already happened and then get your thoughts on maybe what is happening and what might be coming. So firstly, as we were printing new highs like every day, why wasn't VIX breaking down? Why can't we get through 20 even when we're at records, Cem?
It's a supply and demand function here. At the end of the day, a lot of the sellers in vol have disappeared after the March lows. There was structural selling at that point. If you pair that with, increased demand both from retail, which has been significant. Retail has increased from about 5 to 25% of options flow on the back of all this fiscal money and everybody being shuttered indoors. And then you pair that with the death of risk parity, as we're seeing today, right? Rates down, market down. A lot of people are feeling pain and have a hard time diversifying. So vol is one of the few places that you can clearly diversify your tails. So, it makes for a massive supply-demand imbalance in the vol market, and they're just natural buyers whenever we get down to kind of this 20 type level. So I think those are the primary drivers. They're here to stay. I think a lot of people have been trying to bet against it. Obviously, VRP is the volatility risk premium is quite high. So it is an opportunity for those that are nimble and know how to go in and sell vol properly. But I don't see that floor going away anytime soon. Okay, so largely kind of two things here. One is that there's a lot of people that are still buying call options and stuff that are helping elevate volatility to the upside, but then to your point also lack of supply, meaning that there's just not a lot of great ways to hedge, so people just have to keep buying puts even if they're expensive if they want protection. Correct. And then you pair it with that also institutional buying of vol for hedges, which is increasing because of the lack of ability to diversify. Bonds are no longer diversified. Risk parity it no longer works at this bottom floor in rates, and with the inflation concerns, yields are going higher. So how do you diversify? Institutions need to diversify. Retail is bidding up vol on the upside. And so tons of demand, all the supply is gone. It's a simple recipe for higher prices. Okay. All right. Now, what about right now? Okay. We've got a little bit of volatility showing up. Russell's under pressure. NASDAQ, same. What do you see when you go through all of the volatility stuff and the charms and the Vannas and all of that? What's going on right now? Yeah, I was fortunate to call this. For a couple of weeks out, we've been calling this Feb 16th, 17th area as kind of an area to be concerned. What date-wise? Specifically these dates? Specific dates. How come? Very clear about it. Not just that, we called the price. We called 39.52 as the likely high. So we've been spot on. The reasoning here is as you get into VIX expiration, which was last Wednesday, a lot of the vol that's been supplied on the market expires, as well as you're getting, this Friday morning is obviously options expiration as well. So all of the VANA and charm flows that come from dealers in the indexes who are short put, long call, and short stock, they have to buy back all of that short stock into expiration, all of a sudden dissipates. And so when that just starts to disappear and has been a primary driver of the push up in markets, and vol kind of hits its nadir there at 20, as we saw last Friday, 1997 it got to, over the long weekend. You come in on a Monday, the market's up. It's a great opportunity for buying vol and getting short kind of the market. That's kind of the timing of it. There are a lot of other factors. Those are the kind of the vol indicators. But with VIX at the floor of 20, it allows an opportunity for a VIX increase, which will create the negative effect going forward. Obviously, we've had really bad breadth. The market's been overbought. Seasonality's still weak. We've had considerable weakness because of this duration trade with the rates going lower, with the NASDAQ and the leaders kind of lagging, particularly Tesla. There's been a lot of interesting activity there. having it included in the S&P has had its effect there as well. So you have quite a few factors that made it rational to get some type of a pullback here. It's easily predictable. The question here is, does this have legs? I think there's a decent number of people who probably saw this coming. I think it's structural in a lot of ways, this sell-off. So important to watch for the next week and a half, where these structural Vana and charm flows are at their weakest. If we get a technical breakdown here, it could be a lot more than just kind of 3, 4, 5%.
Right.
But we're really looking at kind of that one standard deviation down on the 20-day. If that can hold by Friday of next week, I would expect some decent support, and it would end up being a correction more in time and price, which can be bought into for the spring, especially given the kind of $1,400 fiscal checks that'll be coming in early March. I could see a real retail kind of bid to this thing if it holds up in the next week and a half. But the next week and a half is a time for caution. It's a time for defensiveness, and the mid to back half of the next week. If things start to stabilize, then it might be time to come in and take a look at buying the dip. If not, if we break those technical levels, all bets are off, and you have to kind of be much more cautious there. But we really could get a rebalancing of sentiment here, which is much needed. Kind of a rebalancing of overbought, oversold, breadth, etc. Might have a chance to take over. So I'm cautiously optimistic that if we get to that back half of next week, things will be better. But right now, time for caution, like we've called for, till late next week.
So it kind of sounds like we're in this just kind of air pocket from a vol perspective, to your point around expiries and such. To kind of put it in the layman's terms, it sounds like there are usually certain institutions or vol players that support markets at some point, but now their support has weakened some during this period, kind of leaving the market vulnerable. And the levels to come back, Cem, from a technical perspective, isn't there kind of like a pin sometimes where, there is stability unless it breaks past a certain point, and then it's kind of like, okay, well, now we get gappy? It sounds like your view is that we most likely won't get there, but you do have some price targets in mind to where, okay, if we do get there, heads up, maybe we do start getting gappy lower.
That's exactly right. So the distribution has a fat tail to it to the left, but it's generally narrow, or it's been very narrow because of implied vol compression into this time period. But if you break away from this local vol where it's the gamma is highly supplied and start to break towards the tails, things can get definitely messy. Again, that level that I'm primarily watching on a close is like one standard deviation down to the 20-day, a couple closes below that, and that's a pretty important technical level, and you can start to get some trend following, sell-offs, some risk parity, etc., with vol going higher. So those are that's an important area to watch. But especially with the Biden State of the Union coming, in the next week and a half. I think that's those types of factors can have kind of narrative effects that could break us down, which could really cause some issues. I would watch Tesla carefully as a sentiment indicator. If it starts to break down, it's had a lot of negative charm flows because of all that call buying and the slowdown kind of that we've seen there. There's been a massive buying of margin puts over the last several weeks. So if that can hold in, if the NASDAQ broadly can start to show a little bit more strength, and we get through to the back half of next week without any technical damage, major technical damage, I think it'll be a time to kind of buy into this. But right now, we'll look to buy tails funded with local kind of more local volatility to get some convexity in the portfolio.
Okay, so as long as we don't start breaking through those levels you point out, then probably view this as a more kind of time correction where we just don't make rapid new highs in succession for a little bit and kind of use some of the weakness as buying opportunity. I like the point about Tesla. We were talking about that earlier. Cem, I did a little armchair vol analysis myself last week. I'm kind of curious to get your thoughts on what we were discussing with VIX at 20, because if part of that VIX support at 20 is coming from a bullish sentiment, right? As you point out, it's not all that, right? There's supply dynamics. There are people that just have no other choice but to buy vol as protection, but some of it is coming over the last several months of this incessant buying pressure for call options. So in some ways, if we do start breaking lower in VIX, is it a complex, sign? I mean, for some people, we might see VIX drop and they might go, okay, we're in the clear. VIX is finally below 20. Things are back to normal. But I don't know. It seems like maybe if VIX starts breaking because there's fewer call buyers, that's not exactly the most bullish thing around.
Yeah, the call buying is focused in the NASDAQ and broadly the high tech flyers. So in the indices, you have the opposite. You have actually higher skew than you've ever had. We're in the 99th percentile for skew. So put buyers are definitely dominant in the indices. And so what you could see is in that situation is a compression of tech vol into a decline. Relative to the index, the broad indices and value, which is the opposite of what we've seen. There is something to that, but that said, the calls that everybody's been buying are decaying, and the dealer short stock, the dealer long stock, I apologize, they're having to sell off as those are decaying. So that's kind of part of the driving force of this kind of push lower. It tends to more likely, you're alluding to it, kind of tends to support the market as we move away from the calls. And so there is something to that. Again, it's a reason to think there might be some support as we move lower. But again, the index, the complex is very unbalanced in general relative to history. There's a massive long vol flow. Dealers are definitely short on the wings, and as we saw in March, there's not enough liquidity to support the leverage in the vol market when we start moving lower in a meaningful way. So, I think this market's become really bimodal. You either get 3, 4, 5% drops, or you get 20. There's not much in between these days, and that's a function of market structure.
Okay. S&P 500 right now down 1%. One more time, Jim, what's the level you're looking for here if things get dicey?
The one standard deviation down on the 20-day SMA. So that's kind of the one. On a closing basis, 2 days or so, if we really move past that, that's an area to start to be really cautious.
Okay. All right. So we got to do a little math. I don't know if you know the level off the top of your head. It's the standard deviation of the moving average. Okay. Yeah. Standard deviation away from the moving average. Got it. Appreciate it, Mr. Karsan. Always good stuff. Thanks for joining us.
Thanks for having me, OJ.
Thank you. Jim is a senior managing partner at Aegea Capital Management.